Good evening, ladies and gentlemen. Before we begin tonight, let me ask you a simple but very important question. Who exactly is the Federal Reserve? We hear the name every day in the news. We know it sets interest rates. We know it tries to control inflation. But the Federal Reserve, the Fed, is far more than just a US institution. It is the central bank of the world's largest economy. And because the dollar is the backbone of global trade, every decision the Fed makes sends shockwaves across continents. From Wall Street in New York, to the trading floors in Tokyo, to the financial centers of London and Beijing, when the Fed moves, the entire world pays attention. But here's something that might surprise you. While most people imagine the Fed as the driver of the financial system, the truth is quite different. In reality, the Fed is often reacting to the market instead of leading it. And tonight, I want to take you on a journey through this hidden reality, to show you how bond yields move before the Fed, to uncover the risks buried inside so-called safe US treasuries, and to explore the strategies that can help us survive and even thrive in this unpredictable world. Let's begin with a myth that almost everyone believes. The Fed leads and the market follows. It's the story the media has repeated for decades. But history paints a very different picture. If you study the 2-year US Treasury yield, you'll see something extraordinary. This single number has predicted nearly every major Fed move for the last half century. It always moves first. Think about that. The bond market doesn't wait for the Fed. The bond market sets the stage. Here's the best way to picture it. The 2-year yield is like a smoke detector in your house. When the alarm rings, you already know there's smoke somewhere. The Fed, in contrast, is like the fire department, and fire departments don't arrive until the flames are visible. This isn't theory, it's history. In 2001, as the dot-com bubble collapsed, the 2-year yield plunged months before the Fed cut rates. In 2008, as the financial crisis built, it fell sharply long before the Fed finally reacted. In 2020, when the pandemic began spreading fear, the yield collapsed before the Fed slashed rates to zero. Each time, the signal was clear. The market moved first. The Fed only followed. So, if you are waiting for the Fed to tell you what to do, you are already late. Now, let's talk about risk. Because this is where the illusion of safety begins to crumble. Treasuries are often called risk-free assets. Bankers, economists, even professors repeat this phrase. But in truth, treasuries are not risk-free. They simply carry a different kind of risk. The first risk is timing. Imagine you bought treasuries just before the Fed announced a big rate cut. You might have expected prices to rise, but instead, they fell. You stepped into a boat just as the tide was going out, and suddenly, you're stuck in the mud. That's exactly what happened to countless investors in recent years. The second risk is currency. If you are an American investor, this may not trouble you. But if you are in Japan, or Europe, or anywhere else, you face a double-edged sword. You might earn 3% in dollars, but when you bring that money home, your currency may have fallen 20% against the dollar. Suddenly, your safe investment has turned into a disaster. Japan, the world's largest holder of treasuries, knows this pain better than anyone. The yen has collapsed repeatedly, wiping out much of their returns. So let me be clear. Treasuries are not free of risk. They simply shift the risk into different forms. Now, who exactly buys America's debt? The answer has changed over time. Before 2008, it was Japan. Between 2008 and 2018, it was China. But since 2020, China has been selling. And that left Japan, and later the United Kingdom, to step in. This creates what I call the linked boats effect. Picture 3 boats tied together with ropes: the United States, Japan, and the United Kingdom. If one boat begins to sway, the others must sway with it. If one begins to sink, the others are dragged down too. This is not just a metaphor. This is how global finance works today. A bond sell-off in one corner of the world spreads like a financial virus, shaking confidence everywhere. And make no mistake, the ropes are tightening. The boats are closer than ever. So, what should investors do? How can ordinary people, or even sophisticated institutions, protect themselves? The answer, I believe, is simple. Stop predicting. Start reacting. Don't waste your energy trying to guess what the Fed will do next. Don't sit glued to press conferences, hoping for clues. Instead, watch the 2-year yield. That's the real signal. And when it comes to strategy, favor short-term treasuries 1 to 2 years. Why? Because they offer the best balance. If yields fall, you stand to gain 10, even 20%. If yields rise, you can simply hold to maturity and still earn a safe 3.5%. That's what we call asymmetric risk, where the upside outweighs the downside. But avoid long-term treasuries. A 30-year bond may look safe, but it is a trap. Holding one is like locking yourself inside a room with a ticking time bomb. Not only do you face decades of interest rate swings, but you also face decades of dollar depreciation. Think about it. Over 30 years, currencies collapse, empires crumble, economies transform beyond recognition. Would you really stake your future on a promise that far away? Now let's step back and look at the bigger picture. A nation never truly pays off its debt. It borrows new money to pay the old. The United States is no different. If America chooses the path of Japan printing unlimited money to buy its own debt, it could indeed keep yields low, but the cost will be steep: a weaker dollar and a gradual erosion of trust in the world's reserve currency. And this, I believe, is the real lesson for us all. Don't cling to predictions. Don't rely on promises. Instead, react to signals. Manage risk as if you are steering a ship through a violent storm. Because in a storm like this, survival itself is victory. And so, ladies and gentlemen, tonight we have uncovered some uncomfortable truths. The Fed does not always lead. Treasuries are not truly risk-free. The global system is more fragile than it appears. But there is also hope. With the right strategy, by reacting to signals, by choosing wisely, we can not only survive these storms, but use them to our advantage. If this message resonated with you, don't keep it to yourself. Share it. Discuss it. And if you found value tonight, I ask you hit that like button and subscribe to this channel. Because financial knowledge is not just about making money. It is about survival. It is about preparing for the storms ahead. And together, my friends, we will be ready. Thank you.